It is Saturday night, March 8th, 2026. Wall Street is asleep. The traders who spent this entire week panic buying silver up to $95, watching it crash back to $84, surviving the CME margin hike, surviving the NFP minus 92,000 print, surviving Trump's unconditional surrender post. They went home Friday afternoon thinking they made it through the week. They are not watching their screens right now. They cannot trade right now. The Comex is dark until Monday morning, but there is one market that does not care about Wall Street's weekend. The Shanghai Gold Exchange runs a night session that opens at 8 p.m. Beijing time, which is Sunday morning for most of the Western world, and trades until 2:30 a.m. Beijing time, data track. That session opens in hours, not days, hours. And the people who will be sitting at those trading desks when that session opens have spent the last 48 hours watching something that Wall Street's paper traders have completely failed to price. The Strait of Hormuz, the narrow waterway through which approximately 20% of the world's daily oil supply flows, has vessels avoiding it entirely due to safety risks after tankers came under attack. Silver has already traded above $82 per ounce on the SGE, with premiums pointing to real physical tightness, especially for 1,000-ounce silver bars being pulled from Western vaults toward Eastern demand. Financial content. Shanghai does not trade paper promises. SHFE silver futures are physically delivered. The contract size is 15 kilograms per lot. When you buy silver in Shanghai, you are buying metal that has to exist. Financial content. And tonight, when that market opens, the buyers on the other side of those trades are going to be looking at the same data I'm about to show you, and they are going to bid accordingly. I am going to walk you through exactly what Shanghai sees that Comex cannot see right now: the physical premium math, the Hormuz energy shock calculation, the Comex vault number that every Chinese institutional buyer has already pulled, and then I am going to give you the honest bear case, because this analysis requires both sides. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1. The two markets. Why Comex and Shanghai are not measuring the same thing. Before I give you the Shanghai Open setup, you need to understand exactly why these two exchanges produce different prices for the same metal. Because most people think silver has one global price. It does not. It has at least three. And tonight, the gap between them is the most important number in this analysis. Comex silver, the $84 number on your screen right now, is the price of a paper contract. Open interest for the March contract is still as high as 429 million ounces, while silver inventory is running perilously low at only 85 to 86 million ounces. Intellectia.ai. That $84 paper price represents a claim against a vault that has 429 million ounces of paper claims sitting against 86 million ounces of real metal. When you buy Comex silver at $84, you are not buying silver. You are buying the right to demand silver. A right that, if exercised by more than about 20% of outstanding contracts simultaneously, the vault mathematically cannot satisfy. Shanghai silver prices are formed through different market structures. Trading in Shanghai is closely linked to physical consumption and delivery, meaning price movements are influenced directly by supply availability and real demand. Western futures markets primarily function as risk transfer and price discovery venues. Contracts are widely used for hedging and financial positioning, and most trading does not result in physical delivery. FX Empire read that distinction carefully. Comex, risk transfer and financial positioning. Shanghai, physical consumption and delivery. These are not two prices for the same thing. They are two different things that happen to be measured in the same unit. Regional price differences do not always disappear quickly, because physical metal cannot move freely between markets. Import costs, regulatory oversight, financial constraints, and logistical delays all influence how rapidly supply responds to demand. These frictions slow the arbitrage process that would normally equalize prices between regions. When domestic consumption rises faster than new supply can enter the market, local prices may adjust first, allowing premiums to remain elevated until global flows rebalance. FX Empire. And right now, the friction that is preventing those prices from equalizing is not import costs or logistics. It is a government policy decision made on January 1st, 2026. China, which refines approximately 70% of the world's silver, implemented export controls that severed the clean arbitrage route between Chinese refineries and Western vaults. The metal that would normally flow from Shanghai to New York to close the premium gap cannot flow. The premium that would normally be arbitraged away in days has been persistent for 2 months, and tonight Shanghai opens with that premium still intact, plus a brand new energy shock that has been building all week. Section 2. The Hormuz variable. What China knows that Comex cannot price on a weekend. Here is the specific mechanism that makes tonight's Shanghai Open different from every prior Shanghai Open since the Iran war began on February 28th. The world woke up to a dramatically different geopolitical landscape on Monday, March 2nd, 2026. Brent crude spiked as much as 13% to $80 per barrel at the open as United States and Israel's coordinated military strikes on Iran triggered the effective closure of the Strait of Hormuz, through which roughly 20% of the world's daily oil supply passes, the burning platform. That was Monday. Today is Saturday. 5 days have passed. The strait has not reopened. The insurance market has not reinstated coverage for vessels transiting the Gulf. And on Saturday morning, Trump posted 2 words on Truth Social: unconditional surrender. His press secretary confirmed the war continues for 4 to 6 more weeks. Asian economies, including China and India, would be left particularly exposed if the Strait of Hormuz were closed. Their scramble to secure oil from other countries could send global prices higher. A loss of Iranian barrels would cause China to bid for substitute supplies. China is the world's largest importer of crude oil. Approximately 40 to 50% of China's crude oil imports pass through the Strait of Hormuz, the same strait that has had near zero commercial traffic since February 28th. The Chinese buyers who are going to be sitting at SGE terminals tonight have been watching their country's primary oil import route stay closed for an entire week. They have been watching their energy costs rise. They have been watching the dollar weaken against hard assets. And they have been watching Comex silver, the paper price, close at $84 on a Friday afternoon, as if none of this matters. Goldman Sachs estimates an $18 per barrel risk premium already embedded in crude oil prices, corresponding to a 1-month full halt in Strait of Hormuz flows. Wood Mackenzie warns of $100 oil if closure persists. Goldman's analysis suggests 15 to 25% upside for gold, based on historical correlations from the 2022 Russia-Ukraine war if disruptions persist. Bar chart. 15 to 25% upside for gold. Gold is currently at approximately $5,000. 15% is $750. 25% is $250. If Goldman's correlation holds and Hormuz stays closed through April as the White House projects, those numbers are the gold move. Silver, which has historically outperformed gold in the first 30 to 60 days of a geopolitical shock, runs harder in percentage terms. The Chinese institutional buyers opening their terminals tonight know this math. They have had 48 hours with no Comex trading to think about it. And the first price they set tonight will be the first price discovery event in the global silver market since Friday afternoon New York close. Section 3, the Shanghai premium calculation, what the gap actually is and what closes it. Let me give you the specific premium math, because this is where the abstract analysis becomes a concrete number. Silver has traded above $82 per ounce on the SGE, with premiums pointing to real physical tightness. Silver has traded above $82 per Oz on the SGE while Western prices were lower. Premiums that point to real physical tightness, especially for 1,000 Oz silver bars that are getting pulled from Western vaults toward Eastern demand. The Globe and Mail that data point is from before this week's Iran escalation, before the Hormuz closure confirmation, before Trump's unconditional surrender post, before the NFP minus 92,000 print that confirmed the Fed is frozen. The baseline Shanghai premium that existed before this week's developments was already significant. Add 5 days of Hormuz closure, a 4 to 6 week war timeline, and a weekend with zero Comex trading, and the conditions for that premium to widen tonight are documented and specific. China is the world's largest silver consumer, driven by solar panel manufacturing and industrial demand. The Shanghai premium acts as a real-time gauge of Chinese physical demand. When it rises, it often precedes global price moves. The SGE's physical delivery requirement makes it more reflective of real supply and demand than paper-heavy Western futures markets. CME Group. When it rises, it often precedes global price moves. That sentence is the mechanism. Shanghai moves first, Comex follows. Not because Wall Street decides to follow Shanghai, because the arbitrage traders who connect the two markets show up Monday morning and see the gap that opened over the weekend, and they close it by buying Comex silver. That buying pressure is what produces the Monday gap up that the competitor's description is pointing at. A critical distinction for silver investors. Silver carries China's 13% import VAT, which does not apply to gold. This tax is a major component of the Shanghai premium. When Chinese silver trades above Western spot, a significant portion of that gap comes from VAT and import costs rather than pure demand. Data track. This is the honest technical context the bear case will use. Part of the Shanghai premium is structural. It always exists because of the 13% VAT on silver imports into China. It is not all pure demand signal. When the premium is $5 to $8, much of that is the VAT component. When the premium moves to $13 or higher, the excess above the structural VAT baseline is the genuine physical demand signal. Watch which component is driving the number tonight. Section 4. What China has been doing for 48 hours while Wall Street slept. Here's the part of this story that no mainstream outlet is covering, because mainstream financial coverage focuses on what happened to prices, not on what the largest physical silver-consuming nation on Earth was doing quietly while Western paper markets were closed. Much of the action is coming from the East, where the Shanghai Gold Exchange and the Shanghai Futures Exchange are paying massive premiums for silver, platinum, and palladium compared to Western spot prices. These premiums are not about taxes or paperwork. They point to real physical tightness, especially for 1,000-ounce silver bars that are getting pulled from Western vaults toward Eastern demand. London silver lease rates staying elevated and Comex registered silver inventories dropping by roughly one-third since September are more signs that physical supply is under strain. Financial content. 1,000-ounce silver bars getting pulled from Western vaults toward Eastern demand. That is not a prediction. That is a documented flow that was happening before this week. Now add Hormuz closure. Now add Trump's 4 to 6 week war timeline. Now add China watching its primary oil import route stay blocked, while it simultaneously faces export controls on its own silver refining output, meaning China cannot easily replace the silver leaving its domestic exchanges by importing more from the West. China is simultaneously an exporter of refined silver that cannot export, and an importer of crude oil whose import route is blocked. That double squeeze on the world's largest industrial silver consumer is the specific condition that produces aggressive physical buying, not speculative buying. Industrial procurement, solar manufacturers, electronics companies, EV battery producers, they buy silver because they need it to make products. They do not stop needing it because the price is high. They buy more aggressively when they fear supply interruption. Silver has already demonstrated its sensitivity to Middle East tensions, with Comex silver finishing above $93 per ounce as military operations commenced. The convergence of wartime safe haven demand with silver's already bullish fundamental outlook, characterized by deepening supply deficits and accelerating industrial demand from solar energy and electronics sectors, creates a powerful tailwind for prices. Trading key. Silver hit $93 on day one of the war. It crashed back to $84 after the margin hike and the Warsh nomination shock. The physical demand story that sent it to $93 on day one has not weakened. The Comex vault has not refilled. The Shanghai premium has not closed. The Hormuz has not reopened. The war has not ended. Every force that drove the initial spike is still present. The paper market's ability to suppress the price through margin hikes is the one variable that changed, and that tool has now been used 6 times in this cycle, with each use leaving fewer leveraged longs to flush. Section 5, the Comex vault number that Shanghai already knows. Here is what every major Chinese institutional buyer pulled from the CME website before their weekend started. The Comex registered silver inventory as of Friday's close, approximately 86 million ounces. Open interest for the March contract stands at 429 million ounces, while silver inventory runs perilously low at only 85 to 86 million ounces. Analysts warn that if just 25% of the people holding these contracts decide to go for the physical, the Comex would need 100 million ounces, a number that is simply impossible to meet. There is talk that the exchange is offering cash incentives to try to get traders to settle their contracts in dollars rather than taking delivery of the metal. Intellectia.ai. Cash incentives to settle in dollars rather than taking metal. When a commodities exchange starts paying people to not take delivery of the commodity, it is telling you something specific about the state of its physical supply. Chinese institutional buyers understand Comex mechanics. They have been watching the registered inventory drain for months. They have been watching the delivery notices pile up. They have been watching the margin hikes come every Sunday night. And they have been drawing the same conclusion from that data that anyone who looks at it draws. The Comex paper price of $84 is not the real price of silver. It is the price of paper claims against a vault that cannot satisfy all of them. The real price of silver, the price at which physical metal actually trades in the market that requires physical delivery, is higher. How much higher is what tonight's Shanghai session will begin to reveal. Section 6. The gap-up mechanism. Exactly how Sunday night Shanghai becomes Monday morning Comex. Let me walk you through the precise chain of events that connects tonight's Shanghai Open to Monday's Comex Open, because understanding the mechanism is more valuable than any price prediction. Step 1. Shanghai opens tonight at 8:00 p.m. Beijing time. The first trades are set by buyers who have been sitting on their analysis for 48 hours. The Trump unconditional surrender post, the 4 to 6 week war timeline, the Hormuz closure confirmation, the Friday $84 Comex close. Those buyers set the first SGE price. If that price is significantly above $84, if Shanghai opens at $90 or higher, it creates an immediate arbitrage opportunity. Step 2. The arbitrage window. Silver is $84 in New York paper. Silver is $90 in Shanghai physical. Any trader who can buy New York and sell Shanghai captures that $6 spread, except the China export controls block the clean version of that trade. You cannot buy silver in New York, ship it to Shanghai, and collect the premium without navigating a regulatory barrier that did not exist before January 1st. The arbitrage that would normally close this gap overnight is structurally impaired. Step 3. The arbitrage that does work. What traders can do is buy Comex futures on Sunday night in the electronic session, which opens at 6 p.m. Eastern Time, anticipating that Monday's open will reflect the Shanghai premium. They buy futures tonight at $84, targeting a Monday gap up. That buying pressure is what produces the gap up before Comex's official open Monday morning. When domestic consumption rises faster than new supply can enter the market, local prices may adjust first, allowing premiums to remain elevated until global flows rebalance. FX Empire local prices adjust first. Shanghai adjusts tonight. Comex follows Monday. That is the documented sequence, not a prediction, a mechanism that has been operating throughout 2026 every time Western paper prices fell below the physical market's clearing price. Section 7. The bear case. Why the gap up may not happen or may reverse immediately. I always give you both sides. The bear case on the Shanghai gap up thesis is serious, and you need to hold it. The first bear argument, the VAT component. Silver carries China's 13% import VAT, which is a major component of the Shanghai premium. A significant portion of the gap between Shanghai and Western spot comes from VAT and import costs rather than pure demand. Data track. If the Shanghai premium tonight is $8 to $10, and $6 of that is the structural VAT component, the genuine excess demand signal is only $2 to $4. That is a much smaller arbitrage gap than the headline number suggests. The second bear argument, ceasefire risk. The most powerful single event that would reverse a Shanghai-driven gap up is a Trump announcement of a ceasefire or a diplomatic breakthrough before Monday's Comex open. Markets price in quick wins. If Trump's 4 to 5 week timeline holds and Iran's regime cracks without closing Hormuz for good, we could see a sharp pullback. Discovery alert. If any credible ceasefire signal emerges this weekend, the safe haven premium in both Comex and Shanghai evaporates faster than it built. A gap up on Sunday that reverses on a Monday ceasefire headline produces a violent intraday swing in both directions. The third bear argument, the CME margin tool. The Comex is facing a delivery crunch with low silver inventory and high open interest. The exchange has been offering cash incentives to get traders to settle in dollars rather than metal. Intellectia.ai CME has already raised margins 6 times this cycle. If silver gaps up to $90 or higher on Monday's open, a 7th margin hike announcement Sunday night before the open is CME's documented response to exactly this scenario. A margin hike that hits after the gap up produces the same pattern we saw 3 times already this year. Violent spike, violent flush, recovery at lower levels. The fourth bear argument, solar substitution. Industrial demand from the AI and data center sector is boosting demand, but this is getting partially offset by the decline in the solar sector, keeping fabrication demand at around 650 million ounces. Intellectia AI. The largest single industrial consumer of silver is actively engineering silver out of its products. Chinese solar manufacturers, Longyi, Jinko, Aiko, are the primary drivers of silver's industrial demand story. If the substitution accelerates faster than the war premium builds, the fundamental bull case weakens simultaneously with the geopolitical bull case strengthening. The honest bear case summary, the gap up, is mechanically likely given the documented conditions. But the gap up being sustained is a different question. Silver can absolutely open $5 to $8 higher on Monday morning and then get hit with a margin hike or a ceasefire headline and close lower than Friday. Both things are true simultaneously. The Shanghai mechanism produces the gap, and CME's tools can reverse it within hours. Section 8. What to watch tonight and tomorrow. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X, where the data breaks when it happens. Here is your specific watch list from right now through Monday morning open. Comex electronic session. Opens 6 p.m. Eastern tonight, Sunday. This is the first Western price signal of the week. Watch whether silver gaps up or down from Friday's $84 close in the first 30 minutes of electronic trading. The size and direction of that initial move tells you whether the arbitrage traders who watched Shanghai open are buying or selling. Shanghai Gold Exchange live price. The SGE opens at 8 p.m. Beijing time, which is 7 a.m. Eastern on Sunday morning, meaning it has already been trading for hours by the time you watch this. SGE data updates hourly during trading hours. The night session runs 8 p.m. to 2:30 a.m. Beijing time. Data track. Watch the SGE benchmark silver price versus the Comex electronic session price. The gap between those two numbers in real time is the premium signal. If the SGE is running $5 or more above Comex electronic, the physical demand signal is active. If the gap is $2 or less, it is within the structural VAT range and the demand signal is neutral. Trump's Truth Social and White House statements. Any post from now through Monday morning that signals diplomatic movement, Oman mediation, Qatar back channel, UN framework, changes the Hormuz timeline probability and directly affects the war premium in both markets simultaneously. The gap-up thesis requires the war premium to hold through the weekend. Any credible diplomatic signal reverses it. CME Group margin announcement page. Watch for a Sunday evening margin announcement. CME margin hike announcements have come every Sunday in this cycle when silver was showing delivery stress. If silver gaps up above $90 in the electronic session and the CME does not announce a margin hike by 6:00 p.m. Eastern Sunday, that absence of a hike is itself a signal that the exchange is not alarmed enough to use the tool again immediately. SHFE silver inventory. Shanghai warehouse inventory data updates weekly. Combined SHFE and SGE inventory plotted against the Shanghai spot price helps identify whether price movements are driven by real physical demand or financial buying. CME Group. If Shanghai inventory is falling while the Shanghai price is rising, the physical demand signal is confirmed. If inventory is rising while price rises, the move is speculative and more likely to reverse. Section 9. The honest conclusion, here is the full picture as of Saturday night, March 8, 2026. Comex silver, 84. Paper claims, 429 million ounces. Registered vault, 86 million ounces. Coverage ratio, 0.14. Strait of Hormuz. Vessels avoiding the waterway due to safety risks after tankers came under attack. Approximately 20% of the world's daily oil supply passes through this route. Ex-Trump. Unconditional surrender. No deal with Iran. White House. 4 to 6 more weeks. Shanghai silver price formation is closely linked to physical consumption and delivery, meaning price movements are influenced directly by supply availability and real demand, not paper positioning. FX Empire Shanghai Gold Exchange night session opens at 8:00 p.m. Beijing time. Price data updates hourly. Data track. That session is opening hours from now. 3 scenarios for Monday morning. Scenario 1. Shanghai opens significantly above $84. SGE runs $90 or higher. Comex electronic session follows. Monday morning opens with a gap up of $4 to $8. CME does not announce a margin hike Sunday evening. Silver tests the $90 to $92 resistance level that the February 25th trading halt stopped it from closing above. This is the scenario the competitor's description is pointing at. It requires the Hormuz situation to hold with no diplomatic breakthrough through Sunday. Scenario 2. Shanghai opens modestly above $84. SGE runs $86 to $89. Structural VAT premium accounts for most of the gap. Comex electronic session shows modest buying but no dramatic move. Monday opens flat to up $2. Silver consolidates in the $84 to $88 range as the market waits for Monday's specific news catalysts. This is the base case. Not the dramatic gap up, not a crash. Grinding physical premium with paper suppression in equilibrium. Scenario 3. Diplomatic breakthrough announced before Monday open. Any credible ceasefire signal from Oman, Qatar, or UN framework talks. The war premium evaporates from both markets simultaneously. Shanghai session reverses mid-session. Comex electronic session shows selling. Monday opens lower than Friday's 84. Silver tests $80 to $82 support. This is the scenario the bears are positioned for. What I can tell you is this. The mechanism the competitor described is real. Shanghai trading above Western spot. Physical tightness in 1,000-ounce bars being pulled from Western vaults toward Eastern demand. These are documented conditions, not speculation. Financial content. The gap between Shanghai physical and Comex paper is a real phenomenon that has been documented throughout 2026. The question is whether tonight's specific conditions, the Hormuz closure, the war timeline, the Comex vault drain, the 4 to 6 week White House confirmation, are enough to widen that gap materially before Monday morning. Your job is not to bet on my answer to that question. Your job is to pull the SGE price tonight, watch the Comex electronic session open, check for a CME margin announcement, and let the actual data tell you which scenario is playing out in real time. The data is public, the mechanism is documented, and Shanghai opens in hours. Invest with logic, not hype. Protect your capital. The gap between paper and physical is real. Whether it closes on Wall Street's terms or Shanghai's terms is the question this weekend decides. Drop Shanghai watch in the comments if you are tracking the SGE price tonight alongside the Comex electronic session open, and drop gap up or flat open to tell me what you think Monday morning looks like from where you sit right now.